You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today on Wealth Formula Podcast, of course, is our day, our Wednesday, that we talk to Zulfe of Volatility Group. How are you doing, Zulfe?
I'm doing great, Buck. How are you?
I'm doing good. You know, missed you last week. I was like, what? You know, you get to take the Wednesdays off, but you know, I don't. So, what were you up to last Wednesday? More college kid stuff?
Another drop off. So I had to drop my daughter off to her college. I was going to Boston University, so made a trip from my direction, which is DC area, and drove her up to Boston and back down. So yeah, got both kids out now. We are officially empty nesters at this point. So yeah.
Did you spend any time in Boston?
We spent a couple of days. So kind of checked out the different areas, different campuses. It's a nice town. I actually don't know Boston very well.
Yeah, I don't know it very well either. But I do remember. Visiting it, and one of the appeals as a college kid was, I think there was at the time, and it's probably a lot more than this, I think, but there was 80,000 college kids in that town during the school year. Jeez, that must be a lot of fun. But anyway.
Yeah, it's all students. That's all you see everywhere.
Interesting. Well, okay. Well, let's move on to the show. I mean, what's interesting is that you were gone 2 weeks, and I feel like, and we'll get to crypto later, but I'm looking at crypto, and it was like we were like falling off a cliff, and then by the time you come back, it recovered. So there's not much there, but that's the world of crypto. So let's start with the discussion of. Last week's show. I'm curious on the Richard Duncan stuff. Obviously, is probably sort of up your alley.
Well, yeah. I mean, the Austrian economics topic that you guys tackle, I couldn't agree more. I think it's a nice theory, I guess, that might have been practical a century or two ago. That if that's the way the world wanted to head down, I guess maybe it would have been a more gradual, peaceful existence, but that's not the way we went, right? We took on debt. We put credit as an important part of our fuel to grow economies and businesses and even our own personal finances. So I just don't see how we go back. If you think about what separates today successful countries, successful corporates, even individuals, it's their access to ample and low-cost credit, right? So if you've got access to that, you can be successful. If you don't have it, it's hard to move ahead. So, I agree with what Richard was saying. There's just there's no going back without really just total global economic destruction at this point. Consequences to pretty much every aspect of our daily lives. So I thought it was a really interesting conversation. Good to hear from. I like the way Richard, kind of dissects it and puts it into context. So I enjoyed it quite a bit.
Yeah. So I mean, like when you were listening to it, was there anything particularly useful that you thought that in terms of pulling from some of what he had to say?
Well, listen, you guys talked about some things that are quite relevant as well, right? Even though it was in the context of Austrian economics, there's at least several threads that I thought were quite interesting. Inflation certainly is very relevant, right? So I thought his comment, and you've discussed this in the past before too, where effectively because of globalization, the U.S. has been able to keep inflation in check for several decades now. So we've just been able to rely on lower pools of lower cost pools of labor and resources and all of that. So we've effectively kept inflation down.
And conceptually, if people are trying to understand that, again, we've effectively, what we've done is we've exported our inflation, right? So because our own costs of making things and doing the work have gone up, by going to other countries and relying on cheap labor, we are able to actually keep our own costs in check, because otherwise those costs of labor, those costs of, goods produced in the U.S., if they're going up, they're going to just get passed on to the consumer. So I certainly love the idea of made in the USA, but the challenges with that are that, you're just not going to get the stuff at the prices that you used to if that goes away. And that's what globalization is all about. It's really to our benefit, right? It's really ultimately to keep our own inflation down.
Well, yeah, and I think that's the point that kind of hooks back to your discussion with Richard, is that that the fact that we've been able to keep inflation in check in the U.S. has given the Federal Reserve really just unprecedented flexibility to sustain monetary policies that support the growth of credit. So both making sure that there's a ample supply of credit and a low cost supply of credit. And now the question becomes, is the backdrop changing so that that low inflation environment is no longer going to be supported by the globalization trends, and have those globalization trends kind of run their course? Those large pools of low-cost labor, are they still there? I mean, we've seen manufacturing move to China, and then it went to Indonesia, and then it's gone to Vietnam, and just kind of searching for the next low pool, because every time you go into these economies, you get increased inflation, increased cost of labor, and over time, it's no longer that cheap anymore, right? It's still cheap, but not the same, and you're just not getting that benefit of increasing decreasing that cost of labor. So I think that's one big question for me. I think related to that, there's this focus on onshoring manufacturing. Anything
so bringing things back to the U.S., right? I mean,
bringing things back, because what happened when COVID hit, when the Ukraine invasion happened, we saw that the supply chains were really thin and left us very exposed, and they caused huge disruptions, which are still going on, by the way, in certain industries. And so I think there's been this refocus by the government, but also by companies themselves, to say, hey, how do we make sure that never happens again? And so we have to start onshoring, or bringing back some of that capability to the U.S. And then you're seeing that further with from a government perspective, looking at very sensitive technologies such as microchips or EV technology, and saying, hey, we've got to make sure that these are protected from a domestic technology knowledge perspective, right? We don't want to be producing all of this or relying on other governments, even if they're friendly governments. We want to make sure that we have control and capability here in the U.S.
Right.
For those very reasons. So, as you see all of that going on, and then more recently some of the bilateral support for tariffs on imported goods. I mean, obviously, Trump has been out there very kind of on the front on that, but even the Democrats would support tariffs in certain instances. So I think that's definitely a bipartisan kind of issue that I think we're going to be dealing with. So you put all that together, you put the weakening dollar in the face of kind of lower interest rate environments, all of a sudden you're like, hey, you know what? It's actually pretty ripe for inflation to come back if you have all of this stuff kind of happening at the same time. And so I think the implication there is we need to keep an eye on longer term inflation, and I think that's a challenge that the Fed's going to have to continue to combat. It's not going to be as easy for the Fed on their monetary policy to just quickly turn on the tap, because I just happen to believe that if you've got all these other trends coming back the other way, that we're just gonna have to be mindful that inflation can be peaking up often, and needing to be kept under control. So
Right.
something to think about.
Let's talk. One thing I wanted to follow up on is I mentioned to you offline that I got a follow up email from Richard talking about how the U.S. finally has decided to start its own sovereign wealth fund, and he's been advocating for that. First of all, have they called you yet to run that?
No, I'm waiting for the call.
Yeah,
I haven't got it yet.
Yeah. If you don't understand the joke, there's Zulfe used to run one of the major sovereign wealth funds in the Middle East as the chief investment officer. So he's he's doing his own thing here, but who knows? The call could be coming in from the Oval Office.
I'm a little skeptical. I'm a little skeptical on the whole U.S. sovereign wealth fund.
Okay, so let's talk about that. Okay, so because to be honest, I was kind of, this is not my world. And when I brought it up to you, I thought you were going to be like, oh yeah, that's a great idea. But of course, I don't really understand it. But you actually told me you thought it's kind of a silly idea and that there was really no point. So let's start with this. What's the point of a sovereign wealth fund in the first place? I mean, why did Bahrain, where you were in, why did they need a sovereign wealth fund?
Well, it's not just, think about the Middle East. It seems like every Middle East country has its own sovereign wealth fund.
And what is a sovereign wealth fund?
So a sovereign wealth fund is a large pool of capital that the government of a country has earmarked and put into effectively a fund structure. It doesn't have to be a fund, but it's a holding company, so to speak. And that is going to be used and earmarked for various activities that are related to investments, which are related to fostering economic growth within the country, which is related to investing to diversify the economy of a given country. And so when you think of those kind of objectives, which are the typical objectives for a sovereign wealth fund, it makes sense in the Middle East, right? Most of these are oil economies. All they have is oil as their primary contributor to their economies, and they're like, well, we can't forever rely on oil,
right? Because they're going to run out of oil.
They're going to run out. In a generation or two down the road, some of these countries won't have enough oil, and so they have to start thinking about putting some assets in place and investing them in a way that's going to be lasting well beyond their supplies of oil.
And to be clear, these countries do not have like the huge diversity of industries like the United States, and I think that's kind of what you're getting at, right? Yeah,
and even think about Norway's got a huge sovereign wealth fund. Same thing there, right? They've got tremendous oil revenues. It's all coming from hydrocarbons, and the rest of the economy. What is it? Maybe fishing? I'm not. At some point it was. I guess Nokia was there, but
lutefisk. A lot of lutefisk.
Lutefisk.
Right, Minnesota. There's a lot of lutefisk from Norway.
Yeah. So, listen. I'd love to know what the premise is for a U.S. sovereign wealth fund. I could see nothing but problems with respect to a big pot of money that is controlled by the government. I don't see why that makes sense. I don't.
Okay, so let's stop. So the way that the government currently would invest, its assets is what?
Well, the government really doesn't invest its assets, right? So it's first of all, it's a negative. It's in a deficit. It's got nothing but debt.
So where are they getting this money? So where is it tax revenues?
It's all the government's revenues are all
okay. So they're all going to be tax revenues that ordinarily. So I'm trying to So I'm sort of working backwards here. Now, ordinarily, those tax revenues are taking away from businesses and companies that would otherwise invest that money in the private market. So essentially what you're doing is you're taking money that could be invested in the private market and you're turning that into a government asset and investing that money. Is that right?
Well, if you're talking about the system today, what they're doing is they're taking that private sector money from you and me, from companies and so on, and they're using it for the spending that the government does. And obviously, there's huge defense budget, right?
Right.
There's education. There's
Sure.
it's all the money for the people. So it's spending back on what is needed from from infrastructure, from education, health,
Right.
all that kind of stuff. Now, if we had tremendous surpluses, right?
Maybe it would make sense. Yeah.
Maybe it would make sense at that point, or alternatively, you could say, hey, if you got that kind of surpluses, start cutting taxes. You don't need to be collecting that much money. Because I'm always very, very wary of a huge pot of money sitting in the government's control. Why would you do that? I mean, the government's not going to be the one that's going to be best to invest in industries in the U.S., right? Let the private sector, enable the private sector and get out of the way, and let smart people that are in those industries develop those.
Because they don't have the track record says anything, this thing's going to be a massive failure. But
yeah.
But so,
and by the way, I mean, those are the challenges we had at the Sovereign Wealth Fund. I mean, we always had all sorts of run-ins with the government to who wanted to use that money for different purposes. And we had to make all sorts of arguments, protect that capital, and say, no, the reason why we have this money is for not you nor your children, but your children's children and beyond. So we have to invest it in the right way. But there was a lot of temptation from the government, to say, hey, we need that money to build, some roads. We need that money, and that sort of thing. So, I could see a very challenging environment to keep that money there and use it for really productive purposes.
And the alternative is to double down on tax credits and tax benefits. How does the government currently get things done? Well, the way it gets things done is the things that it wants is by providing incentives through tax, right? So, drilling in oil and gas, which is a topic unto itself, but that is a policy that the United States has been wanting to try to become independent of countries in the Middle East. And so it has been extremely attractive tax-wise, right? Like you can basically get these 100% write-offs against even active income and W-2 income. So the way that the government alternatively or typically would incentivize what it wants to have happen is just simply creating tax incentives. If you create big incentives, people will invest in it, right?
Yeah.
So in that regard, I think what you're telling me is that the Sovereign Wealth Fund, it just becomes sort of a clunky vehicle for doing the same thing. Right. I mean, if you want the country to invest in industry, just give it a bunch of tax benefits.
Exactly right.
Right.
Exactly right.
Right. Let the private let private industry do what it does best, which is usually always better than the government's going to do.
Yep. Because the incentives are there and they're aligned for the private sector, right? So if it's an industry that makes no sense or that has no business in the U.S., private sector is not going to chase it, or they're not going to. The conditions have to be such that it makes sense for them. So, I think that's the way to think about it. The government is best equipped to just kind of help the conditions to promote that, to promote those investments, and let the private sector, the smart people that roll up their sleeves and get this stuff done, they're the ones that need to do this.
All right, well, let's move on. What else? We want to talk about the economy. What's going on in the markets?
Yeah, well, I mean, you mentioned I was out most of last week, and it looked like there was a lot of action. It wasn't just Bitcoin, but the stock market in general it really suffered the worst week of the year. Last week, S&P was down 4%, NASDAQ was down 6%. There was an August jobs report that came out later in the week that showed that again the jobs market is getting softer and softer. So there was only 142,000 jobs created. There was an expectation that that number would have been closer to 165,000. Not only that, but then they revised down previous months of numbers that they had reported as well.
So we talked about that before. We always revise down. We never revise up. Did you notice that?
It seems to be a consistent theme.
Yeah.
I think what's happening here is because the market is slowing, I think when they extrapolate and put those estimates together, they're doing it in the context of a market that was hot, right? And so I'm guessing that there's kind of almost a trailing effect here, so
Yeah.
that when things start accelerating, they'll be revising up, and when things slowing down, they're revising down. It's just I think it's just the way they collect the data more than anything. But anyway, so so there was that ADP, which is a very large payroll company in the U.S. They also put out data. They showed that August was the slowest monthly growth of jobs since 2021. So that's showing some consistency there. We have the unemployment rate. Unemployment rate actually moved down a little bit, so that was slightly positive. It went, from in July it ended up at 4.3%. August came in at 4.2%. So that was a little bit of a positive. So it's a mixed bag, but I think there was also kind of some of that Japanese carry trade. I know that you and Richard also talked about that, and we talked about that before. So I think there was continued unwinding just because the markets in Japan have been pretty volatile. So that's been disruptive to that trade, and people are unwinding. You saw that again. A lot of the tech stocks getting hit hard. But then this week, we had a pretty decent bounce back again.
Why?
Because that's just the environment we're in, Buck. I mean, we have people that will react, markets that will react kind of a little too much and overcorrect on news, and then quickly come back the other way. So we're not back to the highs that we were in the equity markets, but we're seems like we're holding steady for the last day or two of this week, and then the bond yields have stayed pretty low. At 10 years at 3.65, 5 years at 3.43. So again, I just contrast that with the equity markets, because it seems like the bond yields are saying, hey guys, we're going to get a 50 basis points cut, and it's going to be a potential, harder landing than you're anticipating. And the equity guys are kind of saying, no, I think we're okay. This looks like a soft landing scenario.
So just to clarify, you're saying that, looking at the 10-year being at 10-year Treasury being lower, like at 3.65. That sounds, gosh, I don't know when the last time it was that low. When has it been that low?
Yeah, it's been a couple of years.
Yeah.
It's been a couple of years. So
and that's for real estate investors, that's good news, because I mean, certainly mortgages and leaking your house and stuff are heavily based on what's in the 10-year mortgage, or I mean the 10-year Treasury rather.
10-year Treasury.
But so what you're saying is that that's sort of a signal that the bond markets, bond guys are thinking that there'll be a bigger rate cut. And what is it? 2 days? When is it?
No, it's next week.
Next
about
week.
This
Okay.
time
Yeah.
next week.
Okay.
Tuesday, Wednesday next week.
Oh, that's right. That's right. Yeah.
So everybody's, all eyes are on the FOMC meeting. I think again, the broad range there is either 25 basis points or 50 basis points. I frankly don't think it makes a big difference which end of that range they end up at. I think the more important thing is that they start that rate cutting cycle.
Right.
If I was a betting man, I actually think maybe 50 basis points.
Really?
But
You
there
think?
is- I just think so, because I think that the unemployment picture is something that's unwinding pretty consistently for now, 5 months. And so I would, if I'm them, I would start thinking about, okay, do I want to start adjusting at levels that it's going to make a difference, because 25 basis points doesn't really seem like it moves the needle much, but 50 basis points, to me, it feels like it's a better signal.
What are the markets betting on that? Do you know?
Right now, it's about 50-50 chance
Really?
For 50 basis points.
No
cut.
kidding. That's changed quite a bit. I still think
has.
think it's going to be 25 because of the election, though. I think they just won't want to stir it much.
It very well could be. It very well could be. And I think the election, despite the fact they're saying that they're not going to be impacted by it, I think the decision could factor that in. There is a CPI report, so an inflation report coming out actually tomorrow. We're recording this Tuesday, so tomorrow being Wednesday, but today as far as actual podcast going out. So
That'll be interesting.
So that'll be interesting if that, if that comes in dramatically different. Markets expecting that, the August year over year level will be 2.6%. If that comes in materially higher or lower, that could, again, you'll see a
What
lot of
was it?
reaction from
The
markets.
last one was.
Oh, it's 2.9, I think, for July. So it's come down.
Okay, yeah, it's 2.9. Yeah, it's.
Yeah.
I bet it's lower. I bet it's
Yeah,
lower.
I mean, let's see it because again with CPI, as you had mentioned before, that lagging
Yeah, the
real
lagging,
estate factor,
the
right?
housing thing is like, it's going to keep coming off the cliff like the way it went up the cliff.
Yeah.
So,
Yeah.
all right. What else?
So, yeah, so largely in agreement with what you and Richard said, which is, there's a couple of scenarios here. Either one, probably equal probability. Either we're going to have a soft landing, meaning, we don't really hit a recession. We kind of flatten out the growth of the economy for a period of time, and then we resume growth. Or we could end up with, a real mild recession somewhere in 2025 before resuming growth. I think either scenario, I think is fine. I don't think it'll be destructive. I think both of them will be, very manageable, and investors can, already start to position themselves to benefit from that. So, so that's kind of where we're heading.
Let's see. What other markets we got to hit here?
Well, for the kind of the product of the week discussion, I thought we would.
Oh,
talk
wait.
about gold.
Before you do that, Bitcoin.
Oh. Yeah, so on, forgot about that. Bitcoin, I mean, like you mentioned, I mean, that's been a roller coaster ride for sure. So, big dip last week, and then, coming back this week nicely. So,
yeah. One of the things, and you'll hear this in next week's podcast is, I was talking to a guy a little bit about Bitcoin. It was in the context of, these central bank digital currencies. And he was talking about how volatile it is. And that's, one of the major reasons they don't take it seriously still. But, we're still talking about a relatively small market cap, right? Yeah. And you've got these ETFs with big inflows and outflows. And that's going to affect, Bitcoin. In the short term, you're still going to have a big ride. I mean, people are still selling quickly because they look at it as tech, and it's the first thing they're going to sell, especially people who are new to the market who are terrified by its movements. One thing I will say that's interesting that I read was that September is in the history of Bitcoin is the only negative return month.
Really?
Yeah. September is the only negative return month.
Meaning on a consistent basis.
Yeah.
Like if you go year over year, it's usually September where it's down.
Right. September is down. Yeah.
Okay. Well, let's see how this September holds.
Yeah.
For sure.
So anyway, I think again, I think for people know in general that I am volatility is your friend, and you look at these opportunities. I saw somebody on Twitter posting a screenshot of one of Peter Schiff's tweets from a couple years ago, and Bitcoin was at 3,800, and he's like, this could still go lower, and it will go lower. It's going to zero. Of course, yeah. And I I used to listen to Peter and take him seriously. Back in the day, he probably cost me millions of dollars in Bitcoin because I used to believe him. But anyway, it is something that, like, I think if you're going to invest in Bitcoin, you need to kind of understand why it is that you believe in it the way I believe in it. I mean, personally, like I said, I think if I were to bet on one thing that in the next 3 years will double, I would say probably Bitcoin, but it might come down as well, and then go back up, and then it might go back down.
You have to have the stomach, right?
Yeah, you have to have the arteries for it. But whoever has it, I think is going to do very, very well in the future. So, okay, so product of do you have some kind of product?
I I wanted to talk about gold because the last few times we've been talking about this, it just keeps hitting a high,
Yeah.
and I never have a really good explanation. So I wanted to dig in a little bit more and just say what's kind of driving this, and then you and Richard also did cover it in the sense of the gold standard and moving away from the gold standard and all that. So I thought it was a good way to come back to it. So, just again, as of today, gold is at another all-time high. Last I checked a couple hours ago, it was about, $2,540 per ounce. If you look at it year to date, that's up 23%. If you look at it over the last 12 months, that's up 32%. And then the price of gold over the last 5 years is up 69%. So that's pretty attractive. What's interesting if you compare it to what's been going on in the S&P 500. So again, year to date, S&P 500 is up 14%. So gold beats it, year to date. Year over year, S&P is up 22%. Again, gold with 32% is ahead of S&P. On a longer term perspective, S&P, the 5-year gain is 83%. And that's where, S&P outperforms gold. So there is something going on more kind of in the last couple of years, and we can get to that, where it's accelerated its performance. And then just for comparison fun, if you look at Bitcoin, some people call the new gold. Well, year to date, that's up 34%. Last 12 months, Bitcoin's up 120%. If you look at it over the last 5 years, it's up 462%. So yeah, so that volatility is there. You probably would have had multiple instances of it being down significantly in those periods, but
That's when you buy. That's when you buy.
That's when you buy.
Right.
Anyway, going back to gold. So one of the reasons for this price to just keep going up. So one reason we talked about before was, central banks have been buying gold, particularly China. I understood, the first half of this year, there has been record buying from the central banks, in terms of adding this to their coffers. And, reasons why they buy it, of course, it's a hedge against inflation. So, that's an obvious reason. But I think there's the likes of China as well, there's a very important kind of diversification away from the US dollar exposure. And that's I think, kind of part and part with respect to the, let's say, the geopolitical type of tensions between the countries. So, why would you want to be all that beholden to your rival or your enemy's currency? And I think there's more and more of that from China coming. And then just the uncertainty overall in the environment makes gold. It's traditionally been the safe haven asset, so I think there is some of that. So I think reason number one, demand is strong from the central banks. They're buying it, and so that's one reason. Interest rates in the U.S. I think reason number two, particularly in the last. Over the last 6 months, why it seems like gold has really kind of accelerated, is that the interest rate expectations are we're going to be hitting a down cycle. That interest rates are going to come down. What that means is the dollar is going to have pressure from an international currency perspective. When you have a lower interest rate environment in a country, the currency of that country is less attractive. It attracts less investments into that currency. So, again, international investors, do they want exposure to a dollar that is potentially depreciating against their own currency? No, because they'll lose money on trading it back to their own currency. Would rather buy dollars if you're an international investor.
Okay, so what's your... how do you feel about gold? From your, obviously you've got Volatility Wealth as well.
Yeah.
And your investors there are dealing in equities, they're dealing in commodities or whatever. How do you approach gold?
Yeah, I think for the right investor, gold is something that we view as a portfolio diversifier. And so, the biggest negative from gold is that it's got this negative cost of carry, right? You're holding the assets, you're not generating any income, and so there's this opportunity cost that you've got to just hold it. And if you're losing money over time, that only makes sense if you think there's going to be a good capital gain at the end, right? And so that has to kind of play out the right way. Now, what I like about gold is the inflation hedge, and so
Right.
what we just talked about at the beginning of this discussion was that you had a whole kind of list of reasons why longer term inflation could be peaking back out again, right? It could be an ongoing concern, and so that's when you definitely want to hold gold when you have an inflationary environment. And so, I don't know if to my clients, I would say be jumping into gold today, given where it's at. Although it probably does have room to run some more. I think Goldman Sachs was just out there saying that their target for the end of the year or into early next year is 2,700 per ounce. And as mentioned, it's
Oh, wow.
2,450. So they still think it's got some room here. But I think that we have to think about, the not the next 12 to 24 months, but when you start positioning your portfolio beyond that, I really think we have to think about putting in the right assets that are going to protect you against inflation. So real estate is the other obvious one, right? You want to have some real estate in there. Hard assets are just good to have. So gold, real estate, potentially other commodities as well. And so that's the way we kind of position it. It's it's not a huge part of the portfolio, but I think it's something that is worth having a little bit of exposure to, just to kind of diversify and be protected against that inflation risk.
I don't invest in gold. And you know what? I'll tell you, the reason is that when you call it a hedge against inflation, I think that's exactly how I look at it. But I also look at real estate sort of the same way, right?
Yeah.
And the big difference being that, real estate, when you're buying, say, your apartment building, or, you're doing your vacation rental, whatever, you're actually throwing off cash flow as well.
Yeah.
And there's and ideally there's not a carrying cost to it. And the other thing is that, obviously it can be a double-edged sword, but, leverage, right, can significantly amplify your returns on that positive cash flow. So I don't know. I've never been much for gold. I mean, when I listened to Peter back in the day, I bought some, I think, but I've got smarter.
No, listen, I think if you compare them side by side, there's a lot of merits with real estate, including the tax ones that, that everybody enjoys quite a bit. And so, you have to think about, okay, does it make sense for me? I think the reason why gold could make sense from a small perspective in your portfolio is that it is an inflation hedge, in the sense that if you hit a rapidly inflationary environment, rates are going to potentially skyrocket again, right?
Yeah.
And if they were to go back on the trajectory of increases that the Fed had done last time, which is highly unlikely to have that kind of steep rise of rates. But if that's the case, real estate gets hurt because you can't exit, and your cost of debt may be going up if you've got floating rate, and so there's a variety of different issues, from just the mechanical process of getting your returns on real estate. If you can hold on to your real estate, that's fine, probably, right? I mean, if you've got your own your own personal real estate. But if you're buying it through a structure which has to exit in 3 to 5 years, and that exit time frame coincides with an unfriendly economic inflationary backdrop,
Right.
relative to where you bought it, that can be a challenge.
Yeah.
And so that's something to think about. I do think the current environment is really good for real estate, because the way I see it playing out, we've got an environment where rates are going to be coming down. So if you can buy distressed properties today and they work in today's interest rate environment, chances are rates are going to be down significantly over the next 12 months. You got a chance to refi down lower. And then if you've got, even the economy picking back up and rates slightly going back up again, well, I still think you've got plenty of room for an attractive exit before anything gets really bad or anything.
Yep. And for sure, I've called this period sort of a Goldilocks period, because at least from SOFR is reliant on what the Fed rate is, and the Fed hasn't done anything yet. So, I do think it's something to think about. We actually do have we have an offering come out the day after the Fed meeting. So, in our group. So if you are interested and you haven't joined Wealth Formula Investor Club, you should definitely do so. And Volatility has something coming out there. Okay, so I know you got to run actually on Thursday, which will be tomorrow for this. After people hear this, you are going to be doing a talk in Rod and Christian's Summit. What are you going to talk about?
Yeah, we're going to talk about the rationale for having a good mix of alternative investments in your investment portfolio, how to think about them, particularly what types of investments are a good fit if you're using those funded cash insurance policies. So
right. Cool. If people are interested in that, I sent out a couple of emails and. Search for emails for me with a subject title, educational opportunity, free educational opportunity. I think it said. I think they have a pretty nice lineup. If you have the time, it's going to be worth the price of admission for sure. It's free, and I think they've got Damon John on there. Damon John.
Yeah.
I don't know where he made his money, but he's like the Shark Tank guy, right?
Yep. Yeah, he is.
Yeah. So. I don't know. Yeah, I don't know how they ended up with Damon John, but hey, there you go.
That's
all
a
right.
good score.
Yeah, fantastic. Well, okay. Well, Damon John will open up for you, I guess. And, all right. Okay, Zulfe, thank you, and we'll see you hopefully next week if you don't have another child to drop off or something.
No, we're done. We're done. Yeah, I'll definitely see you next week.
Okay.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.